Welcome everyone to this session. My name is Michael Von During. I'm the technical specialist for the SAFIN network, which is a network that is housed at IFAD and brings together about 60 different institutions globally to improve access to finance for Agri-SMEs. So this is something that this is a topic that we'll be talking about today that's very relevant to my work and I hope is going to be very interesting for you as well. As you well know, IFAD has been looking at private sector investment for quite some time now. In 2017, it launched its first fund in partnership with the EU and other partners, Pearl Capital in Uganda, a localized, primarily equity fund called the Yield Fund. And that was followed in 2019 by the launch of the ABC Fund, which was a global institution that primarily focused on debt funding, working through financial intermediaries and Agri-SMEs. And so we have two very distinct types of funds and funding mechanisms that IFAD has been involved in. And we're also looking now at, a timeline of about 5 to 7 years of operations, which means that we are at a stage where we can start drawing some real lessons learned from these experiences. And this really bodes well with, the advent of this private sector engagement strategy that everyone is working so hard on, and that's really going to define a lot of IFAD's direction going forward. So these lessons learned will be really important to understand what's worked, what hasn't, and how IFAD can really provide the most value in its engagement in this sector. And so very quickly, we're to go through the agenda, we're going to be getting a short introduction of the Yield Fund and the ABC Fund. We'll then move to an overview of RIA's impact assessment plan for these types of funds to understand how we actually evaluate that. And then we'll actually go over some lessons learned from both funds before opening up to questions. So that's the plan. We've got about an hour and a half. Let me just start off here by opening up a poll to get everyone engaged and get a sense also of your own understanding and experience with these two funds. So we'll take the poll and then we'll move on to the first introduction of the Yield Fund.
I will wait a few more seconds before closing the poll because I see that some of you did not answer yet. So okay. I see the numbers do not grow, so I will end the poll.
I think that it's an interesting finding, primarily to see that we still do have a majority of people that haven't interacted with either of these funds. And so I think now it's time to move on to the first introduction, if that's okay with you, Anais. Okay. So let me introduce Stella Okot. Hopefully I'm saying that right. Finance analyst for the ESSA, East and Southern Africa Division at IFAD. Stella's based in Uganda and is going to be introducing the Yield Fund. Stella, over to you.
Thank you very much, and good afternoon, good morning to everyone. Thank you for joining this call, this webinar. The Yield Uganda Investment Fund is the first. Anis, you can go over to the next slide, please. Thank you. Okay, thank you. The Yield Uganda Investment Fund is the first of only two funds currently domiciled in Uganda. The fund was established in 2017 and offers patient capital in the form of equity, semi-equity, and debt to small and medium agribusinesses in Uganda that have the capacity to create high impact through contributions to rural economic growth, employment opportunities, and market access for smallholder farmers. Now, IFAD is the anchor investor in the fund on behalf of the European Union that provided the initial investment capital, 10 million, that offers a fast loss protection. And this attracted three other investors in the fund. This is the National Social Security Fund of Uganda, the Soros Economic Development Fund, and the Fin Church Aid Investments. So the fund manager is Power Capital Partners, and this is a firm based in Uganda with extensive experience in impact investments in the agriculture sector in the East African region. The total fund size is 20 million, with 16.8 of these allocated to investment capital, and the remaining amount really for the operations of the fund. Now, alongside the investment capital, there is a business development services support grant facility of 3 million, 2.4 million of which is the actual grant going out to the investee companies, and the balance is more of for the management cost for this BDS. And this has been financed by the European Union and managed by IFAD. So in the first slide, I'd shown that the fund life is from 2017 to 2027, really a 10-year fund. Thank you. We can go over to the next slide, really to show the role of IFAD in the fund. The top of which is that IFAD has been the carrier of the EU investment capital. This is the 10 million euros with the first loss protection into the fund. The other roles really is the representation in the board of the investors. IFAD has a seat there, and then representation in the investment committee, where we are an observer seat and with no voting rights, but really we sit through all the investment committee meetings. And the other role is the management and implementation of the BDS component. The other is technical and fiduciary supervision of the operations of the fund, knowledge management, monitoring and evaluation, and finally the impact assessment, which we'll see a little bit more details around how it has been framed. Now, the fund has been in existence for 7 years. We can go to the next slide, please. Thank you. The fund has been in existence, operating for the last 7 years, and has made 15 investments in small and medium agribusinesses in Uganda for a total value of 16.5 million, really committing the entire capital for the investment. And the fund successfully transitioned to the disinvestment stage, and this commenced at the start of 2023 and will continue for 3 years. It's a 4-year disinvestment phase, and now will continue for the next almost 3 years. This is the period through which the fund manager shall be, planning the exits and then actually exiting from these investments. Now, this year, 2024, the fund has recorded one successful equity exit with a decent return to the fund. I'm sure the fund manager will provide us with a little more details therein. Now, in terms of outreach and impact, as at end of December 2023, the fund recorded a total of 136,732 smallholder farmers directly and indirectly supplying these investee companies with raw materials, of which 30% were female. And then in terms of employment, we have the fund recorded 7,713 persons employed This on permanent and casual labor arrangements. The casual labor is normally the time when there is a peak season for most of these agro enterprises. Now, on employment, 45% are recorded to be female and 35% youth. So this is a brief introduction on the Youth Fund, and I take the opportunity to hand over to my colleague to go with on the EBC Fund. Thank you. Yeah. So we just have the portfolio and pictures really, just to show that it's across various agricultural value chains. Thank you.
Thank you. Thank you, Stella. So now let's move on to Frank Rubio, who's the Senior Technical Advisor, overseeing basically or providing technical support for the ABC Fund. Frank, over to you.
Thanks, Michael. Hello, everyone. Maybe move on to the next slide, please. Yeah, some basic facts about the ABC Fund. It is an impact investment fund. It was incorporated in Luxembourg and launched in 2019. The main objective of the fund is to invest, catalyze blended capital, and mobilize technical assistance to underserved agribusiness segments. The fund is independently managed by a Luxembourg fund manager, Bamboo Capital Partners, with an investment advisor in Jaro that manages directly the Agri-SME portfolio, and they will be presenting momentarily. It is institutionally independent from IFAD. IFAD has the role of a shareholder on its own account, as well as on behalf of the account of the European Union and Luxembourg. And other shareholders in the ABC Fund include Agra and Bank of America, which was the first private sector investor in the fund. Next slide. The role of IFAD. Some similarities to Uganda. First of all, as I mentioned, we have two named directors on the board. They act in their own personal capacity. That's important to emphasize. They're nominated on the board of directors. One of them is acting as the present chair of the board. We are also on the investment committee, and we do not have voting rights, very similar to the Uganda Fund, but we do provide technical backstopping and feedback on all the investments that come through. Important role and one of the pillars of the fund is around pipeline, where IFAD provides a strong support and identification of viable projects from the project portfolio. And also IFAD manages the TAF, which is the Technical Assistance Fund, which is close to 4 million EU IFAD co-financed to provide TA to support the structuring and monitoring of the ABC Fund. And IFAD is also holding, as an investor, a direct investor, C shares, which are first loss shares, in its own name and on its own account. And again, as mentioned earlier, on behalf of the EU and Luxembourg independently. Next. Basically, ABC Fund offers three types of products: direct investments to Agri-SMEs, cooperatives and farm organizations, with the idea that it focuses on the underfinanced and profitable segments of agriculture and the agribusiness value chains. Indirect investments to financial institutions that target small producers, farm organizations, and Agri-SMEs, and non-financial assistance through the provision of technical assistance and advisory services. Next slide. And the financing approach, generally speaking, IFAD has, as I mentioned before, no influence on the actual investment decisions. We play a role in the investment committee, but only as an observer. But we're not involved in the decision-making process. The ABC Fund can invest directly in rural SMEs and indirectly to financial institutions. According to the investment strategy, there's a target ratio of between 60 and 40 between indirect and direct investments. In terms of eligibility, as previously mentioned, there's farm organizations, cooperatives, and financial institutions, as well as Agri-SMEs with ticket sizes between 200 and 800,000 euros for direct investments, and up to 4 million for indirect investments in financial institutions. Next slide. And just a little data on the current portfolio. Right now, the portfolio is at around 30 million euros. Since its inception, the fund has processed through the investment committee up to 51 investments. Currently, the organization, the fund operates in 11 countries, 9 in Africa and 2 in Latin America. And again, manages up to 30 million with 15 direct investments to Agri-SMEs and 13 indirect with financial institutions. Next slide. Thank you. Over to you, Michael.
Perfect. Thank you so much for that, Frank. We're going to be moving now actually to a very short introduction of RIA's impact assessment plan, which comes at the tail end for both of these funds, really sort of assessing their impact and trying to understand what they've achieved. So let me introduce Emanuele Zucchini, the technical specialist economist for IFAD's Research and Impact Assessment Division.
Thank you, Michael.
Emanuele?
Yes, thank you, Michael, for the floor. So the first aspect is that, okay, why an impact assessment of the Yield Uganda investment funds? So the important is that given the novelty of this type of initiative, so it's really important for IFAD to generate knowledge to understand the impact that this type of initiatives they have on the small scale producer. The second aspect is the accountability of the investments, and the third aspect is the capacity building that this type of impact assessment exercise can create for development effectiveness. So for these three reasons, the Research and Impact Assessment Division in IFAD decided to provide this technical expertise fund to design the impact assessment and set up the first phase of this assessment. Next slide, please. So the impact assessment of Yield Uganda funds is based on an ex-ante quasi-experimental design. So it's meaning that we collect the data at the baseline and end line. So baseline means before that the SMA start supporting the outgrowers, and after 5 years that these farmers are supported. And then there is this if and if analysis to understand before and after the intervention. So we did this exercise only for a subset of SME. So it talks about 5 SME, 1 per year. And then for a total of 3,000 households divided between treated and control group, because this type of assessment is based on constructing based on counterfactual. That means that we compare what will be in the situation of the treated group if they were not treated. And then we divided these 3,000 more the 5 SMA with a minimum threshold of 300 households per SMA. So this type of assessments allow to have an harmonized questionnaire and indicators to allow that this assessment can be aggregated, but at the same time we keep a sampling strategy for each SMA. So we balance the flexibility for each SMA with a standardized and harmonized approach. Next slide, please. So what we have learned so far. So now basically we completed the baseline phase. So we are entering this year in the end line. So we collected the data for these 5 SME for before that they started to support this grower. So in terms of the data, what we understood is that this type of data provide a very useful information to the SME about these outgrowers. So this helps, first of all, to understand the characteristics of this farmer, and also to tailor basically the support of the SME to this outgrower. So it's basically an information that is given to the SME to better tailor their activities and support to them. Then the second most important aspect is also related to the implementation process. So 2 aspects are very important: is the time and the cost. So the time, it means that if you apply this type of ex-ante, so collecting the data baseline and line, it talks about a process of 10 years. So starting for 2018, that was the first year when we collect the data for the first SME, arriving to the final evaluation of the last SME, we arrive to the 2027. And also in terms of cost, so the data collection analysis, so we have more or less estimated around $900,000. So it's quite an expensive exercise. So thanks, and we'll be happy to reply any questions further. Thanks.
Excellent. Thanks for that. And thanks for being so efficient. You've almost got us back on time. Actually, we're going to be taking that additional time and go to another poll now, to get everyone engaged once more and build on the information that's been shared. So, Anais, can you launch the poll now? And we'll give everyone about 2 minutes. And this is basically sort of, trying to build on the information that was just shared with us on the existing institutions. What challenges and opportunities for Agri-SME finance should IFAD funds focus on going forward? What areas should be prioritized by IFAD? What is IFAD best equipped to address?
I will give a few more seconds because I see that some people did not answer yet, but we have a 70% of participation, so this is great.
Okay, yeah, so far so good. I mean, obviously, we encourage everyone to share their thoughts here, and we're getting stuck pretty much here with, I mean, really in the lead, we see improving Agri-SMEs bankability, right? So the idea there is really to sort of improve their integration into the financial ecosystem. And that's followed by, I mean, closely, risk reduction.
I guess I will just end the poll now and share the
Yeah.
results. Although I think you all saw it. It's over to
No,
you,
but
Michael.
that's interesting. And I think both of those really, really go to essentially trying to address the Agri-SMEs bankability within the financial environment and encouraging, well, I mean, using IFAD funding as catalytic and encouraging other financial institutions to engage. Perfect. Well, thank you for that. So now we're going to be moving to the portion of this meeting where we're going to be listening to people who have really been working with these funds on the ground and who are in a position to share lessons learned. And we're going to start here with Dr. Edward Isingoma Matsiko, who's the managing partner and team leader at Pearl Capital, and is based in Kampala, Uganda. Dr. Edward, the floor is yours.
Good, thank you. Yeah, thank you so much. And I hope you can hear me well.
Yes.
Good. Yeah, so as Stella mentioned about the background of the Yield Uganda Investment Fund and having had the opportunity to be the first fund that IFAD got involved with in terms of working and collaborating with non-traditional financial sector players, which down here, it's mostly the commercial banks and SACCOs and rural finance interventions. So this was a unique approach. So in terms of sharing some lessons and experiences, I will highlight a few from the fund itself, fund level, and then I will highlight a few things of what we look out for, and then I will also highlight a few challenges and potential solutions and things that we've learned along the journey. So from a fund approach level. I think, Anais, is the one slide up on the screen?
I'm sharing it now.
Okay. So from a fund perspective level, in terms of approach, this fund model has been in existence. We've tried it out here for the last 2 decades ourselves. We've had previously managed 3 agri-focused impact funds before we got to manage and work with the IFAD on setting up the Yield Uganda Investment Fund with the EU support capital. And this was an interesting experience. So a lot of the learnings, while had been experienced from our 3 previous funds, we also were able to see that this had its own unique structure. In terms of approach, having a single country, single sector fund came with its own shortcomings in terms of target and the access and ease of engagement between us as local-based fund managers and the fund itself and the investees, the ultimate SME beneficial off-takers. And that then also meant it makes a big difference when you go down to the field and get to see the impact, not just read about it, but feel it, see it on the ground, see some of these projects coming through from bushes, and you see a factory being built, you see structures coming up, you see communities changing. So hearing the RIA program and seeing the baseline surveys, I'm sure we've firsthand gotten a chance to practically get close to developing and being part of the project management and interventions as each of these projects were coming through. Of course, that then meant it was easy for us to share lessons both ways. But key important aspect is that as we got out to deploy the fund, we did then observe that the shortcomings around how much these SMEs appreciate impact investing is still a big learning curve out there. There is not much known, and many times the SMEs will be asking, when you get out and reach out to them, you are looking to support capable teams, you are looking to support business models and strategies that are functional, you are looking to support processes and SMEs with interesting ESG practices, corporate governance, reporting standards, and virtually best corporate governance structures. But none of these in practice for farmers does exist. So you've got to build it. You've got to get on with them. You've got to work with them. And many times when you get a typical business plan from a farmer or an SME in the rural part of Uganda, you get, first of all, in shock. And therefore, it then meant that standard practices for typical funds, where, for example, we had our BDS stepping in post-investment, we now have learned that, look, would have been better if our BDS and technical assistance came in pre-investment. We've learned that that would have been much better, because that then would have meant that we would have improved and started supporting these SMEs much earlier on in the process. And that could have also then de-risked the various SMEs. We've also learned that at fund level, 10 years is short. Of course, it is a 10-year life fund, but clearly for agriculture, should it be 10 years? By the time you come in, you spend 1-2 years of due diligence. By the time you get to deploy the capital, you hold it for 5-6 years. 10 years has flown away. So even when we are talking about, for example, as Stella mentioned, that we've had our first full equity exit, very exciting, good return on a small investment. But then we've left impact on the table. We've left value on the table for the next round of investors that are going to be going into that business. And that then means if this fund life had been much longer and has appetite to take on a longer span, we would have done even a lot better. And in any case, from the experience of IFAD and many of you on the call that have been involved with agriculture, it is a patient, long-term type of intervention at any levels, various value chains. And then, of course, from that angle, we've learned some of those things that it's not same size fits it all. So we think in agriculture would be advocating in future that the farm lives need to be more longer. We think BDS interventions need to come in slightly earlier than post-investment, because then the relevance and the value addition is excellent. But then, of course, we've also gotten to learn quite a few other challenges as we deploy the capital. It then meant things like taking minority interest stakes, the structures of the capital that we deploy in agriculture. Many of these Agri-SMEs are family-owned businesses. A lot of them, more than 80%, will have started as family-owned businesses. So the dynamics of due diligence, the dynamics of pipeline development, the dynamics of how you engage, the dynamics of sharing case studies, the dynamics of announcing investments, all become very sensitive. And how much do they want to share? How much do they want to share their information publicly, even when you have public capital coming in and supporting them? It becomes very complicated, and that then means the capacity building, the trainings, the knowledge transfer, the data quality has got to consistently be improved. And there's a lot of peer learnings that we've had to encourage to happen across the board of various SMEs. And that, we feel, has been more valuable than even doing PowerPoint presentations and getting people in the room. Just knowing, for example, we've had our first equity exit. You should see how many SMEs and promoters and entrepreneurs reaching out and saying, look, how did that happen? How did they do it? How did they get their project working on plan and delivering within cost? How did that go along? What were the lessons? What were the challenges? How did you overcome them? And then you find that culturally, we Ugandans, and many Ugandans on the call will agree with me, we learn from seeing, from neighbors, from seeing what goes on around us than what we learn in class. So that then means if you use hybrid seed next door, you use fertilizer and the crop does well, the next season, I can guarantee you the neighbors will do the same. And before you realize it, we end up with all these things where one season the maize is good and everybody will do it, and then the next season we have issues because the price planted a little and all the farmers have decided to take it slow. So learnings from peer-to-peer learnings and mentoring programs where you select the people who go on the board, sometimes having gray hair on the board in the boardroom is more important than just having all people with the MBAs in the boardroom, and the learnings have been very exciting. So the mix of having the right skill set and lessons learned and knowledge transfer has been very interesting. We've then, of course, also learned that we've got to adapt and evolve as efficiently and quickly as possible. COVID was interesting, because once COVID came, I can tell you many Agri-SMEs in Uganda that we were talking 2 years before COVID about private equity, and they were saying, oh, we can do with our commercial finance. They will not bother with our boardroom. They will not bother with what we do with the money. We don't need private equity. Once COVID came in, after 2 to 3 years of shutdown, many of them realized that the debt will continue growing, and therefore, for those SMEs that had equity, that was the better and most exciting instrument to have in an SME, because then the equity capital was not growing, was not being disastrous and painful to worry about. And in any case, the equity partners were coming and spending time with you and working with you through the process. In some cases, we had scenarios where we had to adapt and to align our BDS and technical assistance support to the prevailing circumstances, so that we have to enhance the value of the SMEs. But also, even when the shutdowns were happening, we had to, the equity partner is part of you. You're together to the hip. So they've got to worry about what goes on with the business, even amidst the shutdown, and what are the solutions, what is going to be the interventions that are needed to be done in a timely manner. Of course, we've also learned very strongly that there is a trade-off between financial return and impact returns. That is very critical, because at the end of the day, even entrepreneurs will ask, why should I care about how much premium to pay to the smallholder farmer? And vice versa. But then also, you're telling me about impact and you want to see it, but then what is in it for me on the pricing of capital? And that, we believe, is an interesting mix. But we also, as we start now exits, we are seeing not many businesses will give you both highs and at the same levels. So we are seeing those that are giving us slightly modest lower financial returns are probably able to give us more and more social impact returns. But then those that are giving us very exciting potential outlook for great financial returns are having less and less social impact return success rates. And that is a natural mix that we are seeing locally, and it will be an interesting study when it comes to looking at the end life baseline studies that have been initiated with the IFAD RIA team. With that, we believe learning never ends, and one key lesson is that there is learning at all various points, right from year one, pre-investment, and now in year 7.5 of the fund life. As we look at the remainder of the 2.5 to 3 years on the fund life, the learning cycle continues at each of the various stages of the fund systems and access processes, and especially the SMEs that are the beneficiaries. And the real learnings are going to be around the exits of what happened, how did we get it right, and what could we have done different. Looking forward to sharing more as we get along. Thank you.
Thank you. Thank you so much for that very insightful review of lessons learned. We're going to be able to delve into some more around that when we get to the questions. But until then, I'm going to pass the floor over to Didier Tago, who's the credit portfolio manager at Injaro Investment, based in Abidjan, Côte d'Ivoire, and he works with the ABC Fund. Didier?
Thank you, Michael. Good afternoon, everyone, and thank you, Dr. Edward, for this, I would say, great introduction to what I'm going to complement. Just briefly to complement what Frank Rubio presented about the ABC Fund, just to give you a sense of the key parameters of the investment strategy of the ABC Fund. So it is a global debt fund with a focus on ACP countries. The core mandate of the fund was really to support smaller farmers through underserved Agri-SMEs. I think it's important to state that initial mandate. That's going to sort of give some flavor of the key lessons that I will be presenting later on. So we specifically target SMEs and farmers organizations. Typically, the basic criteria that we look at is the revenue, which should be a minimum of 200,000 euro. The funding that we provide is both for working capital and capex. We've realized that there is a huge demand for working capital funding for Agri-SMEs, which is not fully served by traditional commercial lenders, and there are some reasons for that. So the funds try to really position on that segment of the spectrum, the working capital, to be able to support the growth of those SMEs, which of course ideally should be working with, should have an equity base which is sufficient enough. And this is where the complementary with the Yield Uganda Fund, is something that we like to see when reviewing an investment opportunity. We can only do debt in other currency. Of course, we have a provision for local currency facility, but for this one, at this stage of the fund, which has been operational for 5 years now, from a risk perspective, we have a policy to fully hedge our local currency exposure, which sort of reduce the spectrum of the Agri-SMEs that we can work with in terms of maturity and repayment plan, we tend to be flexible because we believe that as a lender, as an impact lender, this is an area where we can, provide a different product to those underserved agri-SMEs, reducing, being flexible, in terms of the repayment plan that we propose, sort of tailored the product that we're offering to the specific operating cash flow of these agri-SMEs, and also reduce, when possible, the collateral package without, basing the process, because alignment for interest is key here. Although it's an impact investment, we need to keep in mind that the commercial viability, the financial sustainability of the fund is key. And it also goes to, educating those agri-SMEs, which for us, ideally, after our interventions, is to enable them to get access to local funding, which are available, but which they cannot tap into under the existing setup. This being said, it's been 5 years now that the fund has been operational. Regarding the SME portfolio specifically, we've invested cumulatively close to 25 million euro across 6 value chains: cocoa, coffee, nuts, fruit, cereals, animal feed, and in 6 countries. For now, we have a portfolio which is mostly concentrated in West Africa. Of course, as a global fund, our objectives now is to expand the reach of the fund, especially in Eastern and Southern Africa. Also, for specific topic in terms of the crop that we are targeting, the market that those SMEs are addressing, we try also to diversify the portfolio that we are managing. In terms of the challenges that we see, Dr. Edwards, discussed most of them. As a lender, when you review an investment opportunity, the key question that we ask ourselves is the repayment capacity of these agri-SMEs. Although it is an impact fund, we need to ensure that these questions is properly addressed. We know the challenges that the SMEs may face going from macro events that can have a major impact on the business model to even specific operational issue that they can face, including governance. So we try to be really careful, when conducting the due diligence to make sure, although they have some good and bad experience on that side that I will cover later on, in order to make sure that at the fund level we have a vehicle that is sustainable, because the ABC fund is a permanent capital vehicle. So unlike the other vehicles which have a defined life, in general 10 to 12 years, the objective was really to have a vehicle which will be there available for agri-SMEs in the long term, because this is what is actually needed. So some of the challenges that we see on the ground, of course, challenging operating environment in Africa in general for agri-SMEs, which do not necessarily have the size to absorb the external shocks that may happen. Edward spoke about COVID. We also had in specific countries like Ghana, terrific macroeconomic situation with, huge inflation, depreciation currency, etc. We had the impact of the Russia-Ukraine crisis, which had impact on specific value chain, especially soybean and other cereals. We have one of the portfolio company in Ghana, for instance, which suffered from this, from the high volatility on soybean price. They do processing of soybean into animal feed products. Because of the high increase in soybean prices, most of the producers in Ghana, although they were part of an agri scheme run by this portfolio company, preferred to export the soybean rather than fulfilling the commitment to the company. And what impact this can have on such a small agri-SMEs, just having a control over the operating cost is no longer possible. because when you're dealing with some of organizations, planning can be challenging, although you have the best tools in place, you have your budget in place, you have everything in place, but at the end of the day, you are dealing with farmers organizations, and most of the time, their decision is quick, and the trade-off is mostly around, the price that you are willing to pay. So, in our, due diligence, we try to stress those aspects of the relationship between SMEs and the farmers to sort of push them to have provision in terms of the price that they can be able to pay in case there is a significant fluctuations. We've learned that, conducting due diligence to Agri-SMEs for a debt fund has to be extensive, even closer to what you would have done in the context of an equity fund, because the risk factors are the same. Although the instruments are different, the risk factors are the same. $1 in debt provided to an Agri-SME, $1 in equity remains $1, right? It's just the parameters of the investment that are different. But the difference is that for debt investors, we usually have shorter due diligence period, which sometimes can be a challenge in terms of identifying most of the risk factors and discussing relevant mitigation that can be put in place. And this is where collaboration with the partners, the different players of the ecosystem, I mean, the client, the suppliers, service providers, regulatory bodies is important, just for the initial screening activity to make sure that, our identification process is not flawed, and to make sure that given the reduced due diligence time that we have, we are able to embed, I would say, high-profile Agri-SMEs or Agri-SMEs. We can at least meet the repayment schedule of the loan. And this leads me into the financing structure, which has to be flexible, but at the same time needs to mirror what is available in the local market. So, of course, we are based in Luxembourg. We operate in different countries, but every single investment that we look at, we tend to look at it, from an angle of a local investor, what a local investor, would have put in place for these specific SMEs, and try to be close to that, because the end game for us is to be replaced by the local financial institutions. Definitely more capital, more equity capital is required for, I would say, 50 to 60% of the opportunity that we receive on our desk. One of the reasons why we don't proceed is generally negative equity base for most of them. When you see a positive equity base, this is a good news, and you try to think around creative structure, creative collateral package that we can design to at least give them a chance to get access to funding. So, having more equity capital available for Agri-SMEs, although, from a commercial standpoint, it can be challenging. Edward mentioned some of the challenges that they are facing, but, from a pure economic standpoint, is needed so that, debt funds like ours can have viable opportunities to invest in. We've leveraged the technical assistance provided by IFAD in the fund. I think there has been the lessons Edward mentions around using technical assistance as a pre-TA. We did this, and we saw some good results. For instance, for one of the portfolio companies that we have in the cocoa sector, which was a small cooperative, unlike the others which were operating, in the export market, they didn't have access to the export market. So this technical assistance facility has been critical for them to get prepared to start talking to international buyers and ending up securing sales contracts. So those type of technical assistance geared to improving, I would say, the business profile, the operational viability of those SMEs has proven to be beneficial for some of the SMEs. Of course, continuous learning about price risk management is key. For most of the value chain, this remains a key challenge for us as a lender, because one thing that we want to make sure that when investing into in Agri-SMEs is to make sure that although they're able to source, to process, there is a market, right? And there is a market with a predicted price, which is not always the case. So for some value chain, it's possible, to have specific instruments to mitigate price risk. But for others, you need to look at historically how the market has been evolving, and connecting with off-takers to really have a good understanding of the dynamic of the market. So in a nutshell, for instrument like ABC Fund debt investment to Agri-SMEs, backed by blended finance structures is important, because otherwise we've seen many of our Agri-SMEs will not be able to get access to debt funding. They used to get small loans, but these small loans will never be enough for them to grow and to tap into market opportunities that they have. The key thing for us is really to continue to maintain this, although we have an impact fund, to maintain this commercial mindset, which also is important to educate those SMEs, which at the end of the day need to get out there and speak to traditional financial institutions that are operating in their local markets.
Excellent. Thank you very much, DJ. I'm assuming you're done. Yes? Or did you freeze? No.
Yeah, that's it for me. Thank you.
Thanks. Thank you very much. No, perfect. So that's really interesting. So hopefully we can build on some of those learnings through the next phase, which is essentially the open questions phase. And we've got a few questions that have come through the chat already. But to just sort of kick things off, I would really be interested to hear maybe, very shortly from each of you presenters, how you would describe basically the unique added value that an organization like IFAD adds to this particular sector. So we're talking blended finance solutions, quite diverse, but addressing Agri-SMEs in particular. So Stella, can we maybe start with you?
Thank you, Michael. From my perspective of the yield funds, what comes to mind is IFAD's targeted beneficiaries. These are the rural poor, rural people. And so through the yield fund, the BDS, the business development facility, within there was specific allocation of budgets to take care of engagement with smallholder farmers to ensure that these Agri-SMEs are actually engaging with our targeted beneficiaries in the rural areas. And so we had a bit of funds that was directed to support the engagement that these investee companies had. It could be through the extension, strengthening the extension systems, or even so the certifications of products or trainings to ensure that these farmers are actually applying the right agronomic practices, because ultimately the quality of the produce they are bringing to the agro enterprises would also affect the quality of their final products. So to ensure that within the supply chain, the SMEs are actually dealing with our targeted beneficiaries. So we had a specific allocation or a specific purpose for use of the BDS, really targeting engagement with smallholder farmers. But also the other aspects is more around ESG, the environmental, social, and governance aspect. It was really key that most of these enterprises had to make sure that they're enhancing or introducing some measures that would enhance, their environmental practices, how their safeguards are in place, or even so how they're dealing with their employees, health and safety, because most of them are really agro-processors. What are the issues around employee health and safety? And then, of course, issues around the quality of the products that they actually put on the shelves. So I would speak to that with regards to IFAD's, unique addition to this, really through managing of the BDS and really directing it to support the targeted beneficiaries, and also with regard to ESG aspects and compliance. Thank you. Yeah.
Thank you, Stella. That was really helpful. Frank, do you have some thoughts to share on that?
No, I would agree, starting with what Stella said in terms of the targeting. Certainly, IFAD comes with value added in terms of its focus and its targeting on the rural poor, and the extensive amount of programmatic experience, historical programmatic experience in that area that could be brought forth in terms of increasing financing through Agri-SMEs, financial institutions, to this target group. In fact, in the case of ABC Fund, there was a direct link established, as I mentioned before, which was all around how IFAD would generate a significant pipeline of deals from its programs for ABC Fund. And there was quite a struggle, especially at the beginning, in terms of aligning those kinds of things. I mean, the kinds of programs and projects that were being presented from our PLG, our COSAP, were not necessarily ABC fundable. And that required a lot of training, a lot of knowledge sharing, a lot of information sharing in order for everyone to basically be on the same page. But also, it demonstrated that there's a great opportunity for IFAD in the future, particularly in the private sector, in terms of the different instruments that we have that are more widely focused on blended finance instruments, more so than what ABC Fund has, to be able to really target these kinds of Agri-SMEs that generate from our public sector portfolio or other programs. So I think really ABC Fund has been a test case laboratory in demonstrating how from the beginning towards now, how we were able to change the way in terms of the method in terms of how we establish pipeline coming from our PLG and our COSAP, sort of the strategies to do that, and also the kinds of interventions that we need in order to better be able to expand into the kinds of Agri-SMEs, farm organizations, and cooperatives that IFAD traditionally wants to finance in the private sector. One concrete example, ABC Fund had a strong priority and emphasis on financing cooperatives and farm organizations. The results have not been that great. The main reason is reasons that we obviously know. Most of the cooperatives that were presented did not have even basic financial statements to be able to access finance, to be able to demonstrate their financial performance, which are key sort of factors in terms of being able to conduct due diligence for the ABC Fund. However, what we're doing now is based on these lessons learned, looking at things more holistically. Farm organizations make up one chain of a larger set of actors within their individual value chains. And finance comes in many different ways. One way could be directly through a fund like ABC Fund to the FO, to the farm organization. But other ways is by funding other private sector actors that ultimately channel funding to farm organizations and using blended finance instruments to be able to achieve that. So these are the kinds of lessons that we're starting to generate from ABC Fund that are going to feed right into our future strategy for private sector, which is now being developed. So let me start. There's all kinds of other lessons learned, but that's the one that comes to mind. Thanks.
No, that's great. So does anyone else have thoughts that they'd like to share on this question?
I think I would go two things, two comments here. One is where you started at the beginning. Do people know about ABC Fund and Yield Fund and what we are doing? I think that for me was scary to notice that not many people know. So I think there's a lot of things we're building up and doing that are not known. We get at Yield Fund quite a lot of people reaching out. Can we copy the model? Can we paste it? Can we try and get it to work the way the Yield Fund has worked? Which is nice. But then from this call, one of the things I feel embarrassed about is that maybe we don't share so much information and knowledge out there and the findings with the masses, and even many other development partners and people who could have gotten good use of that. So I think IFAD should share more. And then two, both the successes and the failings, because then you can prevent other failings. And then two, for me, as we start getting into setting up these funds and working through them, we need to appreciate that just like life and nature is, there is turbulence, there is death at the end of it. Nobody has thought about other creative things. There are many people setting up funds for growth, not many people setting up distressed asset funds, for example. Funds that could do the abnormal of the abnormal. So funds or interventions or creative things that could step in for cases like turnarounds, distress, receiverships. We are lucky that IFAD was able to evolve as through the BDS support with Yield Fund to be able to allow us to do some of those interventions when we needed them, turnarounds, administration, receiverships as part of the fund management and exit mechanisms. So I think for me, the last bit is measuring impact. Impact is relative. Sometimes the way it's measured within IFAD could be very different with other people. And I think many times we also have double counting of impact. Yeah, thank you.
Perfect. Thanks a lot for that, Edward. DJ, any thoughts on IFAD's unique value in this space?
Well, to us, in the context of the ABC Fund, I think it's been a creative initiative, it's been a innovative initiatives, building up this blending finance vehicle and putting together, other investors and funders around the table to sort of increase the offering available for Agri-SMEs. When I look at, the profile of those Agri-SMEs, of some of the Agri-SMEs that we've supported, I think, one of the lessons that we can draw is that it wouldn't be possible without this type of vehicle. So of course it comes with some challenges, but it's worth pushing, learning the lessons, and improving the way we as fund manager, right, we review those opportunities and we provide support. From a technical assistance standpoint, this has been one of the key area where I think it has been supportive, because as a global fund, pipeline development, especially when you want to cover as many countries as possible, can be costly and can be challenging. And that's where, having the opportunity through the technical assistance facility to have specific missions, country by country, to support potential Agri-SMEs, to at least prepare even the loan application form, has been something, positive for us, because it saves us a lot of time. When you don't have the appropriate information coming from Agri-SMEs, which is most of the time the case, it mobilizes more FTEs to review and prepare an investment note. So when we have external parties through the technical assistance facility doing that initial work, it's completely changed the way we operate.
Perfect. Thanks for that, Didier. Now that we've covered some of this, let me get into some of the questions that have been shared so far online. I mean, some of them are more operational. And so, I've got two here that are going to be for Yield Uganda and one for Yield Uganda and one for ABC. I mean, if you could just sort of run us through what is meant by the disinvestment mechanisms and what the exit options are for these entities. that you've invested in, and what this means for Yield Uganda. Let's start there. So who wants to take that one?
Okay, I will, and happy for Stella to add anything more. But yes, in terms of the investment phase now, what that then means is we are looking to, over the next 3 years, fully exit the 15 projects, or the remaining 14, because one is already fully exited. And then as we exit, the philosophy, if I'm to use the beef model, which is an agriculture livestock common word, you fatten the cow, gets okay, you get it out, and then you get the capital back. So we are looking to harvest the money back. Where there are debt instruments, we are able to collect and support these SMEs, pay back the debt. We are able to restructure where they need more time because the fund life is limited. We are able to bring in other lenders or other commercial private sector players or other funds to come into those SMEs and exit us as part of the process. But where the businesses can exit us, or the families can do equity share buybacks, that's the best preferred option. And where they are not able to, we're able to get other PE players to come in and take us out. There isn't things like what happens in Europe or the US where you go to the stock market. That's still very, very, very weak here. So you're looking at, for debt is self-liquidation. For equity, you're looking at either the families and the entrepreneurs taking you out, or you're looking at other private equity players coming and taking you out, or commercial players taking you out, or strategic investors that then want to do mergers and acquisitions. Stella, unless you have something else to add.
No, that's all.
Thank you. Thank you. So now turning to the ABC fund, we've got a question that is, I mean, equally sort of operational, and it's asking essentially what the strategy is for the ABC fund to balance its impact objectives with its profitability objectives, and how is that addressed? So, Frank, do you want to take that one?
Yeah, sure. So the ABC fund was established as an impact fund, missing middle fund. So certainly the way that the fund was established were around providing instruments that would be able to absorb the level of risk that the fund was going to take, while at the same time generating sufficient returns to attract private sector investors in the fund. The results up to now have been that while on the impact side, and I didn't present any data, but we do have quite a lot of data in terms of outreach and impact generated from the fund. And while from the impact side, the fund has certainly been reaching its objective and its goals, it's still, and it has in fact attracted one private sector investor back in 2021, it still is in the process of fundraising to try to attract more private sector investors. And it has been a bumpy and difficult road. And part of it is external context. The ABC fund was launched in 2019 and really operationalized right at the time when COVID started. So really the first 2 years of the fund, ABC fund was targeting investments in Agri-SMEs that no one else wanted to because of the risk involved. So there was quite a lot of value added, but also the market context changed quite a bit in terms of risk perceptions of the private sector to invest in these kinds of funds. ABC fund up to now has got a 30 million euro portfolio and growing, but still has not quite reached break even. And of course, private sector investors will come in if they see dividends and returns. So really the challenge that the ABC fund is facing now is how can it maintain financing these higher risk missing middle Agri-SMEs while at the same time getting to the point where it can generate sufficient returns to attract the private sector. So it's a little bit of a give and take. The fund is structured in such a way that it can achieve this. There's a large first loss buffer that's attractive to private sector investors. So that's a big plus. And the ABC fund is nearing slowly but surely break even, but it takes time. And I think if there was any misconception from the beginning when we got into this was that this would be a quick process. And it's not a quick process. It takes time. And especially in the very volatile context that we're operating in now and that we've operated in over the past 3 to 4 years. Over.
Thanks for that, Frank. And I mean, I think that that's very intimately linked to what we're doing here, which is really sort of gathering those lessons learned. And we see that it's an ongoing process, and that's all part of the fund's journey as well. So we're going to move now to another set of questions, which are also we basically have similar questions being asked of Yield Uganda and of ABC. And people are interested in better understanding how these funds are promoted on the ground. So there's the pipeline development part of it, but essentially it's I think the question is really around how do each of these funds make their activities known to potential investees? So who would like to start on Yield Uganda?
Okay. In terms of how do we get it out? It's mostly four ways. One is it's sorry about that. It's four ways. One is we do reach out and make announcements of every deal we do. And because we make announcements, what goes around. So the press releases we do and public awareness programs, it has been very helpful. Then the other way around is through referrals. And then the third way is through conferences and speaking and reaching out. And then the fifth, which has been very instrumental, has mostly been us reaching out to the investees themselves through various other consultants and service providers. Yeah.
Excellent. And so thanks for that, Dr. Edward. And do we have someone who can speak to that, DJ, maybe on the
So
ABC
for
fund?
the ABC, I think pretty much, the same challenge. We try to heavily rely on the partners around the table, IFAD, over international institutions as well, for the referrals, given that those partners in general have local offices in most of the countries. We as fund manager, we have a presence in some of the country, but we cannot be everywhere. So having this pool of partners around, has been helpful so far. Of course, Injaro has been operating, for 15 years now, and has been able to develop some network of partners, service providers in the different countries, which also are a source of funding. I think, given the limited pool of capital available to our fund, we cannot, go that public. We need to be selective, and that's where we have a preference of relying of our partners to get access to the potential Agri-SMEs to be part of our portfolio. The reason behind that is because if an Agri-SME is either part of a program or has worked with a specific partner that we know, we have an initial feedback that's going to feed our initial assessment. And of course, we have a website. We also have industry events in some countries, etc.
Excellent. Thanks a lot for that, DJ. So we're going to move on to a last question here before we start wrapping up. And this is going to be around gender. And the question really is, I think it's to any of you to really sort of understand what the experience and impact has been for you, and maybe whether that's evolved over the timeline of these respective funds in terms of gender equality or trying to achieve more women empowerment. Does anyone have something to contribute to that? Do either of the funds have any specific targets or incentives in place to address that question of gender inclusion?
Well, speaking for the ABC Fund, I think, one of our impact objectives is really to be able to serve at least 30% of women within the target class that we plan to impact. So when we have an investment opportunity where this threshold is met or exceeded, it sort of increase the odds. Of course, we still have the commercial and financial criteria to be met, but that's really present an additional considerations that can change either the structure of the loan that we provide, or even I think the overall assessment of the opportunity.
Excellent. Thanks. Thanks for that. Yep.
Fund, I must say that it was not specifically targeted, gender targeted, or with a gender lens in place. What we do is to track, track the gender aspects in terms of women participation and employees and women participation in the smallholder farmers. But I think we also have a good participation of women representations in the boards that have been constituted with the support of the BDS. So we have at least all the investee companies has a woman representation in the board. And for the investments, we only had one investment that was woman-led, and that has since changed. And I would want Edward also to say something. Thank you.
Yeah, thanks, Stella. I must say it's interesting. From the tracking, we're also seeing the female women lens angle of things. But one that is very interesting is that we are also starting to see that the youth working in Agri-SMEs, even some of the youth that are getting an opportunity to do succession planning where agriculture or business-owned family members are passing on the baton to their children, there is quite a lot of BDS need. There is a lot of hand-holding. There's a lot of support that is required because the mistakes are enormous. And that we are not being nervous about it, but we know if we get into businesses where we have youth that are taking over from their parents or daughters that are taking over from their parents, then we need to quite deploy capital to support them with mentorship programs, capacity building, and guidance at various management levels. Thank you.
Fantastic. Thank you all for those answers. I think that's really helpful, and this sort of leads me to wrapping up this session now, because what I'd like to do is actually touch on some of the points that I found particularly interesting in terms of the learnings, and then maybe close with a last question to our speakers. And so really in terms of the lessons learned, I think what certainly sprang to mind from these different comments that we've been hearing is the importance really for IFAD of building on its existing body of work, its work with governments, the POLG, and you know, as much as it can, continue to leverage that ongoing work in its private sector strategy. But there's also, you know, something really important around the need to continue innovating, sorry. And that's also really around using IFAD's presence on the ground, work in different programs to understand what the needs are, and therefore develop the right types of solutions that are going to address those needs, you know, in a way that really is impactful. We also see that IFAD can rely on a lot of its knowledge and experience around TA or BDS to develop basically, or do the groundwork to develop the pipeline, to really sort of strengthen its targeting in terms of these solutions, which really goes right to that innovation piece as well. And then I think that there's really it's really become obvious that, you know, we need to continue learning. So the experience that we've had here in gathering these learnings and sharing them needs to absolutely continue. And not just internally at IFAD, although I think quite importantly, as we've been hearing, there's a need to maybe more efficiently spread the word within the organization, in order to better leverage some of those synergies across programs and different work, but also learning from others and other partners on the ground, other partners that are operating in this same ecosystem. As we've seen, they've been playing a very important role in ensuring the success of these solutions. We're seeing some clear challenges, which are, you know, questions that IFAD will continue to ask itself going forward. And that includes, how do we balance this return, this profitability with, you know, the costs that we're requiring on the ground and the impact that we're trying to achieve? How do we, you know, maintain a really high quality of impact measurement at such a high cost? How do we stay in the game by balancing sort of the long-term support, continued support, reliable support, with playing a catalytic role that brings other players into the sector? And so I think that those are some fundamental questions around what IFAD's role is here. And that leads me to my final question to our speakers today, which is, you know, how do you see, or in your view, how do you see these lessons learned guiding IFAD's private sector investment strategy going forward? And what should that look like? Who would like to start? Stella, can we start with you again?
Okay, sure, thank you. On top of my head, I think about what it takes, the works in all this. Just dealing with or engaging directly with the private sector players, the Agri-SMEs and the like, it really requires an enhancement in our capacity as an institution to be able to carry on, to be able really to understand the space at which these investees are, but also appreciate that we would need a lot more capacity in-house built, but also TA support or business development support, which really would be crucial because our targeted group, if you look at the SMEs in this consideration, they're not the top players, they don't have all the systems in place, their governance needs to be enhanced, so much work needs to be done. And so we need to be in position to have some allocation to really handhold and work with these SMEs, because ultimately they tend to be a direct link to our targeted beneficiaries if they're based in rural communities. And if our mandate is for this group, then we need to invest and have resources in-house to build the capacities, both at IFAD side, but also an allocation for these SMEs. Thank you. I think I have. Thank you.
Thank you, Stella. Frank, can I pass this over to you as an IFAD staff member?
Yeah, just very briefly. I mean, I think ABC Fund and the Yield Fund have been incredible laboratories and test cases for IFAD in terms of lessons learned on how to address the very tough nut of providing finance to high-risk agri-SMEs, financial institutions, and small producers. I certainly think that one of the key lessons learned is the fact that you need a larger array of financing and blended finance instruments in order to target these kinds of sectors. You need a lot of patient capital, while at the same time very much engaging from the onset private sector players in everything having to do with design of programs around this sector, implementation, strategies, etc. So, I think the targeting of both funds is exactly the kind of targeting that we want to continue in the private sector in the future. We have a wider array of instruments that we can offer, fortunately, through our private sector program, which I think will also allow for even better results than what we've achieved so far in these two programs. And we will continue to be generating lessons learned because ABC Fund is going to continue for quite some time still. So the synergies continue to happen, and we hope to get even more interesting lessons learned in the future. Over.
Excellent. Well, it seems that we've reached the end of this session. So we're going to close here. I want to thank all of our speakers for taking the time to share your experience and share those lessons learned. I think, well, certainly for me, they were extremely valuable. And I think, as Edward was saying, it's an ongoing process. It's a continued journey of continuing to learn from these experiences and applying them going forward. So thank you, everyone, again, and have a good day, afternoon, evening, wherever you are.